If you've ever swiped your business card for something personal and thought, I'm just going to sort it out later, this video is 100% for you. Because that habit, the one that feels totally harmless in the moment, is probably one of the biggest things quietly making your books unreliable, your tax prep harder, and your business look less credible than it actually is. And most people don't find that out until it's already a mess. In this video, I'm going to show you why mixing personal and business expenses creates far more problems than just messy books. What it's actually signaling about your business to anyone who looks at your financials from the outside, and the separation plan that makes this whole thing a lot simpler to manage. But before we get into any of that, I want to start with something that probably feels pretty familiar. Everyone has a junk drawer. You know the one I'm talking about. Keys that don't go to anything, dead batteries, a takeout menu from a place that's been closed for like 3 years, random rubber bands, birthday candles, maybe a mini flashlight that definitely doesn't work anymore. It all ends up in there because it's easy. And honestly, it's fine. It works fine until you actually need to find something. And then you're standing there digging through it, moving stuff, and you can't find what you came for because everything's just mixed together. No system or organization. It's all technically in there somewhere, but when you need to put your hands on the right thing fast, you can't. That's exactly what mixed personal and business finances look like inside your books. Everything is technically there. QuickBooks Online is full of transactions, reports are being generated, but when a lender needs clean records, when your CPA is trying to prep for your taxes, when you're trying to make a real business decision and you actually need to trust what you're looking at, you're standing at the junk drawer. And that's a problem we can fix. So let's get into it. Number one, your books stop telling the truth. So here's where I want to start, because I think this is the one that hits the hardest once people actually see it. Your profit and loss report is supposed to show you how your business is actually performing. Revenue in and expenses out, as well as what's left. That's it. That's what the report is for. And personal expenses should never appear on that report, ever. Depending on how your business is structured, personal transactions generally go to owner's draw or are treated as a distribution, not to an expense category, not anywhere on the P&L. Same with personal income. If a personal check gets deposited into the business account, that belongs in the same place. The moment personal transactions start showing up on your profit and loss as expenses or income, that report stops being accurate. If your business structure has you as the owner on payroll, then your salary will show up on the profit and loss. Now, here's where it gets more complicated, because how this plays out depends a lot on who's actually managing the books. If you're doing your own bookkeeping, the question becomes, are you actually categorizing personal expenses as personal? Because if you're not, and you're letting them flow into expense categories without flagging them, your P&L is now including personal spending as if it were a cost of running your business. Your expenses look inflated, your profitability looks lower than it actually is, and then you're making decisions based on numbers that aren't telling you the truth. Decisions about hiring, pricing, whether you can afford something, all of it based on a picture that's just wrong. And look, there's also the question of whether someone's doing that intentionally. Are they trying to write off personal expenses as business? That's a whole other problem, and honestly not something a bookkeeper or an accountant is going to help you with. But even when it's not intentional, the result is the same: messy, unreliable numbers. Now, if you do have a bookkeeper or an accountant handling your books, here's what that actually looks like on their end. When they see a transaction and they can't tell if it's business or personal, it doesn't just get categorized and moved on. It goes into what's basically a holding account, an uncategorized or ask my client bucket. And then they have to reach out to you. Is this business or personal? What's this for? What about this one? And if you're mixing business with personal consistently, that question is coming your way 20 times a month, if not more. That's 20 interruptions, 20 back and forth conversations, 20 things that slow down your close process. And every single one of those touches costs you money because someone's time is being spent on it. But here's the other scenario. What if your bookkeeper isn't asking? What if they're just making a call and moving on? If they don't know what something is and they throw it to owner's draw to stay safe, that might sound fine. But what it means is that legitimate business expenses are not on your books as business business expenses, which means you're potentially missing deductions you actually had. And you won't know that until tax time when your CPA is looking at a profit and loss that doesn't reflect what actually happened in your business. So the options are you get hit with a constant stream of questions, which costs you time and money, or things get assumed, which costs deductions. Neither one of those is a good outcome, and both of them come from the same place: business and personal being mixed together in the first place. The fix is simple in theory: keep them separate. Pay yourself the right way for your business structure, which we'll talk about in a minute, but spend personal money from your personal account, because when that's actually happening, your P&L reflects your business. Your bookkeeper can work clean, your CPA has something real to work with, and you can actually see how your business is performing without having to untangle it first. Number 2, tax prep gets harder and more expensive, and not in the way that most people think. Okay, so this one I really want to sit on for a second, because I think there's a version of this that people imagine in their heads. And then there's what actually happens. And those two things are very different. Here's what a lot of business owners assume: my books are mixed up, but I'm just going to bring everything to my CPA at tax time and they'll just figure it out, right? Like the CPA is just going to snap their fingers and sort it all out and file the taxes and everything will be fine. That's not how it works. Generally speaking, your CPA is not going to go through a year of mixed transactions and separate personal from business for you, at least not without charging you significantly for that time. And the thing about tax season is that it's the most expensive time of year to need that kind of cleanup, because everyone's in the same position at the same time. In my experience, CPAs are slammed during tax season. Their capacity is full. And generally speaking, the clients who show up with clean books get prioritized. The clients who show up with a mess get pushed, which means your taxes might not even get done when you need them to. And then even if your CPA does get to your books, here's what that actually looks like. It's not a quick fix. It's back and forth, constant communication. What was this for? Was this personal or business? What about this one? Because your CPA doesn't know whether that Amazon transaction was for the office or your house, or whether that subscription is something you use for work or something completely personal. They're working with what you give them, and if they make a wrong call, business expenses can get moved into personal, which means you lose deductions you actually had coming to you. Nobody intended for that to happen, but messy books make it possible. So now you're paying for cleanup, you're paying for the tax filing on top of that, you're potentially losing deductions you were entitled to, and depending on how the books look, your tax liability could be affected in ways that are hard to untangle after the fact. I'm not a tax professional, so I'm not going to go too deep into this piece, but I want you to understand that walking into tax season with a year of mixed personal and business transaction isn't a small inconvenience. It's layered, it's expensive, and it's a problem. And here's the other thing I need to say. This isn't a tax season problem. It's a year-round problem that people only notice at tax season. If you're mixing personal and business every single month and doing nothing about it until it's time to file, you're just letting it compound. Every month you don't deal with it is another month of cleanup somebody's going to have to do eventually. The earlier you build the habit of keeping things separate, the less that cleanup ever has to happen at all. Number 3, it can create real legal exposure. So I want to be really clear up front that I'm not a lawyer and this isn't legal advice. If you have specific concerns here, please go talk to your attorney. But I think this is worth understanding at a basic level, because most people have no idea it's even a thing. When you have an LLC, one of the main reasons you have it is the legal separation it creates between the business and your personal assets. If something goes wrong in the business, that structure is supposed to protect you personally. That's kind of the whole point. But that protection depends on you actually treating the business like a separate entity. And one of the things courts look at when that protection gets challenged is whether personal and business finances were mixed together. Commingling funds is consistently listed as a key factor in those situations. Now, courts do have a strong presumption against removing that protection. It doesn't automatically go away just because you used the wrong card a few times, but consistent commingling weakens your position. It signals that you didn't actually treat the business as something separate from yourself. And if you're ever in a situation where that matters, you want your records to show the opposite. And here's the audit piece that I also want you to think about. If you ever get audited and your books are full of mixed personal and business transactions, that auditor is going to look at what's there and ask how they're supposed to know what's actually a business expense. Where's the receipt? Where's the proof? And when personal and business are so intertwined that even you can't clearly explain what something was for, a lot of those expenses can get kicked back as personal, which has a real financial consequence. Again, not a lawyer, not a tax professional, but this is worth knowing. Number 4, it signals something to anyone looking at your financials from the outside. This is the one I think people underestimate the most, because most of the time, business owners are the only ones looking at their own books. So the outside view doesn't really register. But think about this scenario. You want to bring in an investor, or you need a loan, or you're applying for a line of credit. Whoever's reviewing your financials is going to look at your books, and what they're going to see is what's actually in there. So say an investor pulls up your owner's draw account and they see personal transactions throughout. That tells them this owner's using the business account like a personal wallet. And that's not a picture that inspires confidence about where their money is going to go. Same thing with lenders. Consistent personal spending through business accounts signal weak controls and poor cash management. It doesn't matter how strong your revenue is. If the records look sloppy, the business looks risky. And here's one more scenario I want you to think about. What happens when you want to sell the business someday? A potential buyer is going to look at your financials to assess the health of the business. If what they see is personal transactions flowing through consistently, draining cash mixed in with everything else, how are they supposed to determine what this business is actually worth? How do they evaluate the real margins, the real profitability? They can't. And I highly doubt a serious buyer is going to move forward on a business where the books don't give them a clear, trustworthy picture. Clean financials are part of what makes a business sellable. Paying yourself through owner's draw and keeping personal on the personal side tells a completely different story. Both scenarios involve money moving from the business to you, but one of them is documented, intentional, and clean. The other one looks like you're just grabbing from the register whenever you need something. Only one of those looks professional to someone on the outside. Number 5, it might be hiding a bigger problem. So this one's a little different because it's less about the mixing itself and more about what the mixing sometimes means. When I see a business owner who's constantly moving back and forth between personal and business, sometimes that's just a habit, a convenience thing, but sometimes it's a symptom of something else going on underneath. If your business regularly needs personal money coming in to cover expenses, or if you're constantly pulling from it for personal needs without any real structure around that, it might be pointing to something worth looking at. Overspending, no real plan for what owner pay should actually look like, inconsistent profitability that nobody has named yet. The mixing makes all of that harder to see because the books are so noisy. You can't get a clean read on what's actually happening. So the problem just keeps going and the habit keeps continuing, and nobody ever gets to the root of it. Separating your finances doesn't automatically fix the underlying issue, but it does make it visible. And you can't work on a problem you can't see. So now that we've talked about what mixing actually costs you, let's talk about what the fix looks like. And I want to be real with you about this. The separation plan isn't complicated. It's not a system that requires a lot of setup time or a big financial overhaul. It's mostly just a set of habits. And like any habit, the hard part isn't understanding what to do. The hard part is actually doing it consistently. So let's walk through it. Number 1, open dedicated business accounts and actually use them. This is the foundation of everything. If you don't have this in place yet, this is where you start. At minimum, you want a business checking account, a business savings account, and if possible, a business credit card. 3 separate things, all exclusively for the business. All of your business income flows into the business checking. All of your business expenses flow out of it or out of your business credit card. That's the whole rule. It's not more complicated than that. Now, I know some people are listening to this and thinking, I already have a business account. Okay, but are you actually using it exclusively for business? Because having the account and using it the right way are two different things. The account's just the container. The habit is what makes it work. And I'll say this too, a lot of people put off opening a business account because it feels like one more thing to do. But most banks make this very straightforward. It doesn't take long, and once it's set up and you're running everything through it consistently, your books become so much easier to work with. For you, for your bookkeeper, for your CPA. Everyone downstream benefits from that one decision. Number 2, pay yourself intentionally. This is the one that makes the biggest difference for most people. And it's also the simplest swap. Instead of running personal expenses through your business card whenever you need something, you pay yourself first. How that looks depends on your business structure. If you're a sole proprietor or a single member LLC, not taxed as an S Corp, you're typically taking an owner's draw. You transfer from your business bank account to your personal account, and then you pay your personal expenses from there. If you're an S Corp owner, the IRS requires that you pay yourself a reasonable W-2 salary through payroll before taking any distributions. The specifics of that are worth a conversation with your CPA or accountant since the rules are different. But regardless of your structure, the principle is still the same. You pay yourself intentionally through the right channel, and your personal expenses come out of your personal account. One clean transfer, clean record on both sides, and everything personal stays on the personal side where it belongs. But here's the thing, to actually make this work, you have to know your number. You have to sit down and figure out what your personal expenses actually are every month. What do you need to cover your bills, your life, everything on the personal side? Because if you don't know the number, you're always going to feel like there's not enough. And you're always going to default back to just swiping the business credit card. You have to do the work to figure out what you need personally before you can set up a system that actually holds. And if your cash doesn't come in on one predictable schedule, that's okay. A lot of business owners aren't getting a consistent paycheck the same day every month. So instead of waiting for some perfect moment, you set up your pay to match when the cash actually flows. If you're getting paid in chunks every few weeks, you pay yourself in chunks every few weeks at a set amount. You adjust your personal expenses to work with that schedule. You would do that if you were working for someone else, right? You would figure out how to make your personal budget work around your pay schedule. This is the same thing, just for yourself. Now, if you're doing this and consistently finding that there's not enough in the business account to pay yourself what you need, that's something you need to look into and evaluate. Because the answer to that isn't to keep blurring the line. The answer is to look at what's actually going on. Is it a pricing issue? Is it an expense issue? Is it a cash timing issue? Maybe a business line of credit makes sense to help bridge the gap on larger expenses. Something you can pay down when the cash comes through. Not as a crutch though, but as a tool that's used intentionally. There are options, but using the business card for personal is not one of them, because all that does is hide the problem and make the books worse at the same time. And I'll say this as clearly as I can. If you can't pay yourself and you can't figure out how to separate personal from business, that's a sign that something in the structure of the business needs changing. How are you going to bring on payroll if you can't even cover your own draw? These are the questions you need to ask yourself, and mixing the two isn't going to answer them. My biggest suggestion, don't ever open that door in the first place, because the moment you start mixing, it becomes really easy to keep mixing. It's a habit that builds on itself, and the longer it goes, the harder it is to unwind. If you're starting out, set it up clean from day one. If you've already been mixing, now is the time to stop. Number 3, build a process for when mistakes happen. So here's something I want to be straightforward about. Mistakes happen. You're going to grab the wrong card at some point. That happens, and that's okay. But let's also be honest about what a mistake actually looks like versus what a pattern looks like. If your business card and your personal card are the same color from the same bank and they're sitting right next to each other in your wallet, that's a setup for mistakes. So change it. Put them in different spots. Get different card colors if you can. And if you're going out for something personal, just leave the business card at home. There are so many simple ways to make sure this doesn't happen that have nothing to do with willpower. Because here's what I see. Someone tells me they keep accidentally using the wrong card. And then I look at the books and that card was used for personal expenses 20 times in a month. That's not a mix up, that's a pattern. And calling it an accident doesn't make it one. I'm not saying that to be harsh. I'm just saying it because recognizing the pattern is the first step to actually changing it. I'll give you a real example of what this looks like from my end. I've sent a business owner a full spreadsheet of every single personal transaction running through the business account with a clear note that says these need to be moved to your personal card. Go change the card on file for each of these. And their response was, what am I supposed to do with this? And I thought, you're supposed to go change the cards. That's it. That's the whole thing. And that's when it became really clear to me that the issue wasn't that they didn't know the transactions were there. It was that they weren't going to take the time to fix it, either because it felt like too much work or because they figured someone else would handle it, or because honestly, it had just become normal. But it's not fine because personal expenses end up staying on the business side. Business expenses end up miscategorized. And every month that goes by without fixing it, the cleanup gets longer and more expensive. So if a mistake genuinely happens, here's the process. If a personal transaction runs through the business account, document it and record it correctly in QuickBooks Online. Depending on your business structure, it gets categorized as an owner's draw or the appropriate equity account, not as a business expense. And then you move on. If a business expense hits your personal card, you reimburse yourself properly, document it, categorize it correctly, and move on. That's the process. What you want to avoid is making this process your main system. Mistakes are manageable. Patterns are a problem. Number 4, reconcile monthly so you can actually see what's happening. This one's something I really feel strongly about, and it's probably the step that most people skip. Monthly reconciliation. Here's what reconciling your books every month actually does for you. It forces you to look at what's happening. You're matching your transactions to your bank statements. You're catching anything that doesn't belong. You're seeing where money went and whether it makes sense. And if something personal slipped through, this is where you catch it before it compounds. This is also where patterns become visible. If you're reconciling every month and you keep seeing personal expenses in the business account, you can see that. You can name it and you can make a decision about it. That's so much better than letting it pile up for 6 or 12 months and then trying to figure out what happened. Monthly reconciliation is also just good financial discipline in general. It's where you catch missing transactions, errors, duplicates, charges, things that were categorized wrong. It's your monthly check-in with your own business finances. And it doesn't have to take a long time if your books are clean, which if you're following the rest of this plan, they will be. And here's the question I want you to get in the habit of asking every single time you go to purchase on any account. Is this actually a business expense? That one question asked consistently is what prevents a lot of the cleanup from ever needing to happen in the first place. So if you're sitting here thinking, okay, I actually want to get this set up properly, but I'm not totally sure where to start, I built something for you. It's a free business and personal finance separation plan. It walks you through exactly how to structure this for your specific situation, what accounts you need, how money should be flowing, and how to pay yourself in a way that keeps everything clean. You can build it out right now and you'll have a clear picture by the time you're done. Click the link below. It's free and it'll take you less time than you think.